Welcome to Alpha Recap, the StockAlpha.ai podcast, where we break down the market moves you need to know. Markets were closed for the day, and today we're recapping a tech-led correction, a very watched SpaceX story, and some interesting cash flow signals from industrials and utilities. As always, if you have questions, you can reach us at StockAlpha.ai.
Great to be here. So, what really stands out here is the juxtaposition. Heavy headline growth on one hand and murky profit timing on the other. That set the tone for the session.
Right. To kick off the headlines, the semiconductor names Micron and Marvell helped push the tech sector into what analysts called an official correction this week. That pushed volatility higher in AI-exposed and chip-linked stocks.
Not a great week for chip stocks. Momentum indicators and sector breadth weakened, and memory and networking demand were front and center as drivers.
Yeah, that tracks. When you step back and look at this, corrections typically follow concentrated leadership and stretched valuations. When those big names signal weaker orders or inventory build, it ripples fast.
Totally. And then layered on top of that was the SpaceX storyline. Reports said Starlink revenue has topped about $11 billion, which is huge for a private company. But Elon Musk also said he cannot predict when the company will be profitable. That created a real debate about how to value growth without profit visibility.
And the number that really caught our eye? Starlink, over $11 billion in revenue. Big top-line traction, but the lack of a clear path to free cash flow raises valuation questions.
Exactly. Some analysts lean toward emphasizing growth trajectory and private market demand, while others said models should prioritize cash flow scenarios. It's not settled, and that uncertainty mattered to the tape.
Quick reaction. Wow.
Short and sweet. Right.
Let's unpack the macro backdrop for a sec. U.S. Treasury yields were relatively steady, but markets were also parsing geopolitical headlines, reports of U.S. strikes in Iran, and the calendar of upcoming inflation prints. Those pieces matter because steady or higher yields compress valuations on long-duration growth names.
Right, and to add to that, steady yields today still keep pressure on discount rates. In plain English, if yields tick up, the present value of far-off profits drops. So growth names, especially those pricing in earnings years out, felt that squeeze.
And that's where the rotation conversation comes in. Analysts were talking about moving towards stocks with clearer cash flow or lower forward multiples. For example, Caterpillar raised its quarterly dividend by 8% to $1.63, reported first quarter revenue up about 22%, and showed a backlog of about $62.7 billion.
That's a meaningful package of signals. Dividend lift, strong revenues, and a big backlog. In capital-intensive industries, a backlog is basically a forward revenue indicator, so that helped value-oriented and income-oriented investors recalibrate.
And then there was Vistra, which coverage flagged as one of the cheaper names in the S&P 500 on a forward price-to-earnings ratio, roughly 16.8, with upside estimates near 50.2%. That's a classic value case, getting attention amid tech de-risking.
Yeah, but voices diverged. Momentum investors noted that macro and sector risks could erode near-term earnings, so that cheap multiple wasn't an automatic win. So it's really a debate between value mean reversion versus momentum risk.
Let's talk about consumer staples and legacy software, because analysts were generally cautious there. RBC kept a watchful stance on Oracle after mixed results, and Bernstein started PepsiCo at market perform. The tone was neutral. Not bearish, but conservative where catalysts were unclear.
Analysts cited uneven metrics and left price targets mostly unchanged. The takeaway is, when top-line or margin drivers are mixed, expectations get pegged down and patience is required.
Moving on to some of the debates to watch. First, Bank of America's framing of Meta's AI push. Is heavy AI capex a necessary investment or a margin sink? Bank of America suggested the infrastructure could enable future monetization, but others worried the timing and scale could depress margins if monetization lags.
Right. It's not binary. Success depends on execution, ad product innovation, and user engagement. If those line up, the capex could pay off. If not, it's an earnings headwind.
Short reaction. Hold on. Say that again?
It just means capex can be an investment or a cost, depending on whether the company turns that infrastructure into revenue. Timing is everything.
Now, back to SpaceX and IPO dynamics. Analysts agreed Starlink's revenue scale was impressive, but they split on how to value that revenue without profit clarity. Some advocated modeling options and strategic optionality, like defense and global broadband, separately from base case cash flow.
Which is where event-driven allocators come in. You need scenario analysis and real options thinking for a headline IPO like SpaceX. Treat initial pricing as provisional and consider staged exposure or hedging.
A quick aside, Carnival's Q2 call on June 23rd was noted as a calendar event to watch for travel sector re-rating. Semiconductor earnings and inventory prints were also flagged as pivotal to see if the correction deepened or stabilized.
Yeah, those are proximate catalysts. And then there's inflation data, CPI and PCE prints, which can move Treasury yields and thereby reprice discount rates for growth stocks.
Let's cover implications by investor type quickly. Income investors. Caterpillar's 8% dividend bump and a long streak of increases suggested resilience, while Target's modest 1.8% raise to $1.16 was informative but not transformative.
For value investors, Vistra's valuation stood out as a potential pick, but due diligence on regulatory, commodity, and earnings variability was emphasized. For growth and momentum traders, tech's correction raised risk thresholds, and the advice was to re-anchor models closer to cash flow timelines.
Event-driven allocators. SpaceX is a headline event with a lot of optionality and unclear profitability timing. Use scenario thinking. Macro and fixed income sensitive portfolios should watch the curve for breakpoint levels that matter for duration exposure and also monitor geopolitical headlines.
Right, and a few practical next steps analysts suggested. Reassess cash flow visibility across holdings, watch the earnings and event calendar, monitor inflation and treasury moves, and blend valuation and momentum signals when rebalancing.
So, what really stands out here is the message to be cautious and data-driven. Don't chase headlines. Reframe models around cash flows and multiple macro scenarios.
Yeah, absolutely. And one small but useful note, even modest dividend moves can shift allocation conversations. They matter more in aggregate when growth narratives are under scrutiny.
Quick reactions. That makes sense.
Big move.
Before we wrap up, a few clear takeaways. First, tech moved into a correction this week, driven by semiconductors and demand signals, which increased short-term volatility. Second, marquee growth stories like SpaceX showed strong revenue but unclear profit timing, prompting debate on valuation anchors. Third, value and income metrics, think dividends, backlog, and forward price-to-earnings ratios, regained prominence as points of reallocation. And finally, macro catalysts like inflation prints and treasury yields remain the proximate triggers that could reprice long-duration equities.
To close, analysts' stances were broadly cautious and data-driven, and the best approach for many investors is to model multiple scenarios and prioritize cash flow visibility. This is informational only and not investment advice.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. We'll be back after the next set of earnings and data prints to walk through what changed.